Hi, Bill Brooks, CPA in Boulder, Colorado. I've got some tax planning ideas that may work for you. This one is in regard to paying out money from a trust. And you probably know a little bit, but basically, trusts are good for certain things in terms of estate tax planning, laying up money for future generations. On the other hand, there's a narrow tax bracket associated with trusts, uh, and there's a new 3.8% Medicare tax on net investment income. Now, this narrow tax bracket for trusts means that the trust will be in a higher tax bracket much sooner. So, in order to reach a 39.6% tax rate on earnings, an individual has to earn up to $406,750. On the other hand, a trust only has to have earnings above $12,150. So trusts can get to that high tax rate pretty fast, and also that 3.8% Medicare surtax as well, pretty fast, up to, remember, $12,150. Thus, the combined tax rate is 43.4% for trusts with income over $12,000 that have investment income. So let's say you set up a trust to benefit an adult child. If the trust has $30,000 in taxable income, and your child, just to make up a number, has $100,000 in taxable income, the total tax liability would be $32,000, basically combining $10,000 basically for trust taxes, about $700 in trust surtax, and $21,000 in individual income tax. Now, let's say the trust pays out $20,000 to a beneficiary. The trust income tax bill would be only $2,431. The child would have extra $20,000 worth of income, would have to pay $26,700, but would not owe the surtax. Thus, the tax would be $29,200, with paying out $20,000 in distributions to the beneficiary. Whereas before, the total tax without a distribution was $32,000. Thus, there'd be a savings of about $2,800 with paying out the distribution of $20,000. So, distribution funds from a trust could have consequences that might outweigh the potential tax savings. For instance, paying out more to a beneficiary could you've got to take into account other beneficiaries, while balancing their needs for future needs like grandchildren. So you've got to consider the big picture. And then, of course, increasing payments to a younger child could create new tax filing obligations, and then also raise issues about how this beneficiary is going to handle the money. So run the numbers to see if this unorthodox strategy works for you.